Okay, I am doing this video as a response to a question from a student. And this question comes from the homework quiz chapter 5, and it is question number 5. All right. So as various ones of you are looking at this video that I'm making, understand that your question may have been a little bit different, but we're going to go ahead and answer this one question here as my response to a question that was asked by a student. So on the 1st of July, 2016, Alpha Company purchased for $76,000 equipment that had a service life of 8 years. In other words, the useful life is 8 years, and the estimated residual value, what we call scrap value or salvage value, that's the amount that after they've used it for 8 years, they can dispose of it for, or what they estimate, and that was $4,000. Okay, Alpha has recorded depreciation of the equipment using the double declining balance method. On the 31st of December 2018, before making any annual adjusting entries. So what this means is that they're at the end of 2018, but they haven't made any adjusting entries for the depreciation for 2018. All right, so that's why we have here, it says, and let me just kind of emphasize this word here, before making any of the adjusting entries. They sold or exchanged the piece of equipment for new machinery that has a fair value of $35,000. The transaction has commercial substance. So even though it is equipment that's being exchange for machinery, they're saying that these two have two completely different functions. That's why it has commercial substance. So commercial substance means that we have exchanged one asset for another asset that does something else. So the way that we're going to do the accounting is as if we disposed of the old machine and we acquire the old equipment and we acquired the new equipment. And I'll show you the steps for that. But let's see, it has commercial substance, and what we want to do is prepare all the journal entries without explanation to record the events for December 31. Now, please note that since it tells us that they exchanged the equipment before they had recorded any adjusting entries, and the one that concerns us here is the depreciation expense adjusting entry. So we're going to have to do, number one is figure out what was the depreciation expense for 2018. Now, I'm going to go ahead and work through this table, and let's just kind of put some notes here. So the price of the asset that they originally purchased on the 1st of July, the price of the equipment, let me put some, I'm going to just, all right, was $76,000. That just doesn't, I want a color to kind of stand out a little bit more. All right, now the useful life. They said here, useful life is 8 years. All right, and we'll just note that this is years. And they said that the salvage value or the residual value, they anticipated to be, bear with me a second while I make this visible, $4,000. Okay, so this is the information that we have. Also, we note that they're using the double declining balance method. So recall, with the double declining balance method, we do not use salvage value when we're computing the depreciation expense for each year, with the exception that when we get down to the latter years, we're never going to depreciate it so that the carrying value is less than $4,000. So the carrying value, that's the value on the books. Let me put this in here. So the carrying value is going to be equal to the cost minus the accumulated depreciation. All right. And this carrying value cannot go below 4,000. All right, so I'm going to do the table for the computing what is the depreciation expense for 2018. So when they first purchased it, I don't like that term beginning of the year carrying value, because we actually purchased it on the 1st of July, but we'll just work with that. It was $76,000. That was what they first acquired it for. Now remember, our double declining balance rate, all right, so DDB rate is going to be equal to 1 over the useful life, and the useful life is 8 years, multiplied by 2. Since we're doubling it, we multiply it by 2. And let me put this as a percentage. So the double declining balance rate is 25%. All right, so I'm going to copy. I'm going to say it's equal to 25%, but they did not own it for all of 2016. They only owned it from July to December, the 1st of July till the end of December, which is 6 months. So we need to multiply this by 6 out of 12. And, well, let me make this into a percent. Okay, so therefore the depreciation expense for the 2016 is going to be equal to the carrying value multiplied by the double declining balance rate. And then this will give us the depreciation expense for 2016 when they owned it for half a year. The accumulated depreciation then is just going to be nothing from any prior year plus the $95,000 that they took during this year. So the accumulated depreciation at the end of 2016 is going to be equal to the depreciation taken in prior years, or the accumulated depreciation from prior years, plus the depreciation expense for the current year. Well, there were no prior years. All right, so then the end of year carrying value is going to be the beginning of the year carrying value minus the depreciation expense for the year. Okay, so let me just maybe add, oh dear. Okay, well, I'll put a note over here. So the end of year carrying value is going to be equal to the beginning of the year carrying value minus the depreciation expense for that year. Okay, now when we get to 2017, then the beginning of the year carrying value is the carrying value from the end of the previous year, which was $66,500. Now the depreciation rate, since they had it for all of 2017, is going to be 25%. So our depreciation expense in 2017 is going to be equal to $66,500 times 25%. And what I'm going to do is I'm going to say round here, and I want to round to 0 decimal places. And oops, not 0. And the reason that I'm going to do it to 0 decimal places, because depreciation expense is an estimated amount, so we don't need to carry it out to the nearest penny, even though they don't say that here. And as a matter of fact, in some of the other classes I teach, depending on the size of the organization, we may round to the nearest thousand or dollars instead of to the nearest dollar. Okay, now, so at the end of 2017, the accumulated depreciation is going to be the accumulated depreciation from the prior year plus the depreciation expense from the current year, and that would give us $26,125. All right, so now the end of year carrying value is the beginning of the year carrying value minus the depreciation expense, and that gives us $49,875. Now, another way that you could compute the ending carrying value would be to, excuse me, let me find a different color here, purple maybe. Okay, and that is, we could say that it's equal to the cost, which was $76,000, minus the accumulated depreciation, and that will also get us to the same amount. So there's different ways of skinning a cat, but I'm just going to use this method here for our computations. Beginning of the year value minus the depreciation expense that we have for the period. All right, so that was 2017, and it was at the end of 2018 that they made the exchange of this equipment for machinery. And the beginning of the year balance, 2018, on the equipment was $97,875. The double declining balance rate is still 25%. So therefore, the depreciation expense for 2018 is going to be, and I meant to say round, so I'm going to add it here. I want to round this to 0 decimal places. All right, so we have 12,469, and the accumulated depreciation at the end of 2018 is going to be what it was at the end of the previous year, 2017, plus the depreciation taken in 2018. And then now we can compute the end of year carrying value, which is the beginning of the year carrying value minus the depreciation expense. Okay. So the first journal entry that we're going to need to prepare is the journal entry to record the depreciation for 2018. Okay, so let's see here. I'm just going to say here then the journal entries. And the first journal entry, oh no, it's not what I wanted to do, sorry. Okay, so the first journal entry that we're going to have is the journal entry to record the depreciation expense that for 2018. All right, so in this case here, it's the 31st of December 2018, and we're going to debit depreciation expense. And the depreciation expense, we calculated it here, $12,469. And then we're going to credit accumulated depreciation. And that would be for the same amount. So that's our first entry. Now the second entry that we have to do is to record the exchange. Now, they tell us that this was commercial substance. So when it says that it is commercial substance, that means that if there was a gain on the exchange, and by gain on the exchange, I mean that the asset they received was greater than the book value of the asset that was given up, then we're going to record that gain. If there's a loss, we always record the loss. But let's go back here and do a couple of journal entries. I mean, not journal entries, computations. Okay. Bear with me a minute. I'm trying to kind of use different colors, and I don't think I did such a great job with that color. Okay, so now the first thing we need to do is figure out the book value. All right, and to recall, book value is equal to cost minus the accumulated depreciation. So in this case here, the book value is going to be equal to the cost. The cost was $76,000, and the accumulated depreciation just before they sold it was $38,594. And so really what we're seeing here is that the carrying value at the end of the year is the same as the book value. All right, and that was $39,406. Excuse me, I said that wrong. I meant to say $37,406. Oh boy. Okay. Now we want to know, well, was there a gain or was there a loss? And the gain or loss is determined, then the gain or loss is going to be equal to the fair value of what was received. Okay, so the fair value of what was received minus the book value of what was given. All right, so that is our formula. And note here that the fair market value of what was received, it was this machine that had a fair value of $35,000. So let me add in here. Okay, so we have here then the fair value of the machinery received, and they tell us that it was $35,000. All right, so now we can figure out, was there a gain or a loss? So we received, or Alpha received, an asset that had a fair value of $35,000, and they gave up a piece of equipment that had a book value of $37,406. So what we see here is that they're going to record a loss because this asset was worth less than the asset that they received had a fair value that was less than the book value of the asset that was given up. All right, so now we're ready to make the second entry. And please note, the second entry is to record the exchange. So step number one, we need to remove from the books anything that is associated with the equipment that they are going to be giving up. And the equipment has two things that are on the books that we need to remove: their cost and their accumulated depreciation. So let me just note here. So one, we need to remove the cost and accumulated depreciation on the books that relates to the old equipment. And then number 2, we need to record the loss on the exchange. And finally, for number 3, we're going to record the new asset. And this new asset was the equipment. All right, so to do that, 31st of December 2018. All right. So the new equipment, so we debit equipment, and that's going to be for its fair value of $35,000. So I'm going to take this from right over here, $35,000. All right. Okay. All right, so we've done, that's actually recording the new asset. Now, the loss we computed as $2,406. And whenever there is a loss, we're going to debit the account, loss on the exchange, and that loss was, and I'm putting a minus sign first. Oops, well, let's see, let me put it this way, equals a negative of this amount here. And I don't like these dollar signs in here, so let me remove them.
It's 16 hours.
Okay. And then I'm going to remove the cost and the accumulated depreciation. Well, we know that the cost was $76,000. So I'm just going to, oh, excuse me. Let me put this here. This is machinery. Okay. And it was the equipment that they originally had. So I have here equipment. And that was $76,000. That was its original cost. And then I'm going to need to remove the accumulated depreciation. And remember, accumulated depreciation is a contra asset. Contra asset means it goes against some asset, but the normal balance is credit. So if I'm going to remove the accumulated depreciation, which has a credit balance, I'm going to have to debit accumulated depreciation for the amount that is in that accumulated depreciation account, and that was $38,594. All right, so then these are the 2 entries that are required. Number 1, the entry to record the depreciation expense up to the date of sale or exchange, and then to actually record the exchange itself. Now, I just want to do a couple proofs here. Normally, we don't do this in journal entries, but I just wanted you to be sure that the debits for the second entry equal the credits for this for that same entry. Okay. All right. So I'm going to end here. I hope this is helpful, but if it isn't, please feel free in either the Ask the Professor or homework discussion topics. Please ask your questions there so I can perhaps clarify things a little bit more. Okay, bye-bye.